on this computer. There we go. Okay. Real life traders, welcome. We're going to talk about debit spreads today. Give me one in the chat here if you were already familiar with debit spreads. One-ish, 0.5. I got a 1. Excellent. 0. Blake, you're going to learn a lot. Rock, you're going to learn. Cool. Okay. Now, before I go into debit spreads, and please do not be shy about responding to this question. Matt, 0. Excellent. Give me a 1. No, actually, this time let's make it a 2. Give me a 2 if you are not familiar with options at all. And again, don't be shy about responding, because I just need to know where to start, whether I should just give the basic rundown of what an option is and start from there, or if I should just get right into. So give me a 2 if you are not familiar with options at all, and you would like me just to give a quick explanation. Starting options this year, Rock. Okay, cool. Okay, so let me just mention, let me just start with this. So options are Matt says he's dipping my toes in options water. Cool. Okay. So options are an inexpensive way to trade the underlying of a stock. So if you think about Tesla, right? If we look at Tesla and, we're talking $700, $800, $900 stock, depending on where we are and what day, right? It's a lot of money to go and buy shares. But I always refer to as options as almost like trading penny stocks, because, and I don't mean literally penny stocks. I would never trade penny stocks, but I'm talking about the fact that you can control 100 shares of an underlying for very little money, meaning pennies on the dollar. That's where I come up with this concept of trading options is like trading penny stocks, because you can trade any ticker, any share price on pennies on the dollar. So that's the cool thing about options. Now, the downside to options is if and there's many option strategies. So, but for anybody just starting out with options and just beginning, typically what they look for are to either buy calls or puts. So when you buy an option, it means you're long, okay? And it gets a little confusing because you can be long calls, which means that you are bullish, or you can be long puts, which means you're bearish. And that's, I think, sometimes a little confusing for beginners with options, because you're like, well, how can I be long on puts? Because typically you associate long with going bullish, but it's actually a terminology that is long means that you are actually a buyer of that option, not a seller. And then when you're short the option, that's when you are the seller of the option. So you can be long calls and puts, you can be short calls and puts. And you might have heard people talking about like for instance, I like to trade naked puts. That just means that I don't own shares of the underlying, but I am selling I'm selling puts at a certain level. So anyway, that's just the quick explanation of options, again, without getting too much. Actually, next week I'm doing an options 101 at this time, so we can get further into just the nuts and bolts of options at that time. But just for the purposes of this presentation, just so that you know that when you're long, that means you've bought an option. When you're short, that means you sold it. And one option contract equals 100 shares of the underlying. So give me a 1 if all that makes sense to everybody. Cool. Especially, Matt and Rock, the people who are newer to options or trying to learn. So just, again, I just want to be clear, make sure that you understand. Now, does anybody have any, before I go into the debit spreads, does anybody have any questions about what I just mentioned? I'll get a sip of water while I wait see if there's any questions. Okay, no questions. That's fine. All good. Let me let me move my chat pane around a little bit here. Okay. So you are still seeing this page with the debit spread, correct? With the title page? Just, yep, perfect, cool. Okay, so let's get into it. So money management rules. First of all, I think this applies whether we're talking about debit spreads, options, shares, whatever. Don't trade with money that you can't afford to lose. I think that goes without saying, but you never know. Some people just want to get into trading. They don't understand the risk part of it, but do not trade with money you can't afford to lose. That is rule number one when it comes to trade. All right. So a second rule is something that I always talk when I'm doing either a one-on-one coaching or if I'm doing group mentoring. I always emphasize that you should trade with an R that's small enough that it feels insignificant to you if you lose, right? So that could mean it could be $25, it could be $100, it could be $500, whatever that amount is, and it's going to be different for everybody. So especially people with a smaller account, new to trading, you might be hesitant to trade with a larger number, and that's fine. Again, if the number that you're trading, if that R that you're using is making you uncomfortable, then maybe you should think about lowering it. So anyway, trade with an R that is, I always refer to like, if I lose on a trade, I lose an R. I don't know. Can justify it by saying, well, that's like, dinner out one night, or it's a week worth of buying coffee at Starbucks, or, drinks out with friends, something like that. Right. So that's how I look at my R. So, and then the third thing here, and sometimes people will refer to their R as a percentage of their account. Okay. So never risk more than 2% of your account on any one trade. Those of you who are in the funded account know that that's kind of set up with a 2% R there. But again, that's subjective. You don't have to trade the 2% rule, right? It can be 1%. It can be any dollar amount you want. So for instance, right now with the funded account, I've had it maybe, I don't even know if I've had it a month, but I got the $200,000 account, right? In theory, that means I should be trading with a $2,000 R. Well, I'm not, because I'm new to the funded account. I'm learning that there are nuances to it that aren't like trading with interactive brokers or something else. So I'm not using that 2% rule. I'm not trading with a $2,000 R. I am trading with a $500 R in that account because I'm trying to get acclimated to using it. And it's still, even with the number of trades I've taken, I'm still learning that there are some nuances with it that I still need to figure out. So anyway, don't hold that 2% rule as that's got to be the number. Choose whatever number you want. Give me one if that makes sense to everybody, especially you newer traders. Cool. Thank you. Okay. Moving on. When to use debit spreads. Okay. So in general, when you are talking about being a buyer of credit spreads or being a seller, okay, you want to buy options when the implied volatility is low, and you want to sell when implied volatility is high. So let me just ask the group and just throw your answers in there. Give me an example of when on any ticker, when implied volatility is typically high. Just throw it in there in the chat. Any guess? Cindy, nailed it. Boom. Yep. Kelvin. Yep. Earnings. So leading up to earnings. Yep, Dave, before earnings. Leading up to earnings, implied volatility increases. Okay. So be aware of rock Tesla every day. That's a good one. So be aware of when earnings are taking place, because implied volatility does increase as you head into earnings. So you don't want to be a buyer of options when earnings are approaching. You want to be a seller. And there are strategies that are just dedicated towards just getting into options leading up to earnings, and then anybody who has held options over earnings, okay? Is everybody here aware of the term, the volatility crush? Give me a one if you're familiar with that term. Okay, so a few of you know. So the volatility crush is if you ever held options into earnings right when right when the market opens. Let's say you have AMD, and AMD's earnings come out right before the in pre-market, just before market opens. If you're watching the value of that, let's say you're holding calls and you bought those calls because you thought price was going to go up, that that AMD might have a gap up on earnings, and you're right. Let's say you're dead right, and sure enough, market opens, AMD gaps up, your calls are very profitable. If you don't exit that position, let's say within the first hour of market open, you'll notice that even though price is going up, the value of your options starts going down. And that's the volatility crush. So the point here is you just have to be aware of times of high volatility and low, high implied volatility, low implied volatility. And the other thing is when the other time to use the debit spreads, we talked about it, but when buying shares requires too much capital. So again, depending on the price of the underlying, it might not be feasible to buy a lot of shares in a stock like Tesla or something like that. So with a small account, you can use debit spreads instead of buying shares. And so one thing I'm going to show you quickly here is just to give you an idea of, people will say, okay, well, what is low implied volatility, right? So if you're looking at a ticker, you're looking at, a chart, how do you know when there is low implied volatility, right? So throw it out to the group. Does anybody have a simple, easy method for determining when there's low implied volatility? Just go ahead and put it in the chat pane if you have an idea. Toss, yep. List the value, good. Kelvin, yep, I'm going to go there too and show. Anybody else? And again, it's fine if you're not sure, but I'm gonna give you the answer anyway. That's the beautiful thing. So let me go to a different share. Okay, everybody should see my chart of Amazon now. Just give me a 1. Perfect. Cool. Thank you. Okay. So Thinkorswim. This is one of the reasons. Isn't there a ticker for IV? There might be an IV. I'm not sure. But one of the reasons why I'm a big fan of Thinkorswim is it was created for option trading in mind. That was the original intent of Thinkorswim when it was created. It was for options trading. So it's a very robust platform, but the options features in it are spectacular. So if we go into the option chain, so if you go up here and you click trade, again, this is anybody who's not familiar with Thinkorswim. If you go to trade, this is the option chain. So we're looking at Amazon, and here's the option chain for Amazon. And these are all the expiration dates. So you have, today's expiration, which 0 days left here in parentheses, and then next week's, which is 7. And then you get into, each of these is listed as weeklies. The rest of these are monthlies. So the September 16th expiration, there's 35 days left. So that's what those numbers mean in parentheses. And then again, you can determine whether it's weeklies or monthlies just by the designation here. But if you look over on this side here, okay, see those percentages? Well, those percentages are the implied volatility. Okay, so it's a quick and easy way to just look and see, well, is it high or is it low? And if everything is generally the same, it's average, right? It's so, but again, you don't know whether it's low, but you know that everything's in line with each other, except for look at this one, right? Today, because it's expiring today, today's implied volatility is greater than everything else. But you can see that everything else is in the mid 30s, right? So generally in mid 30s. So if you were looking to get into Amazon, you could look at that kind of as a down and dirty way of going, okay, well, I don't see anything out of the ordinary. Everything looks about the same. So that's probably means that implied volatility is reasonable right now in terms of if you wanted to buy options. Do we have, does anybody just know off the top of their head something, some ticker that has earnings coming up early next week? I didn't bother going and trying to find, so HD. Thank you. So let's look at Home Depot, okay? So you can see here, options, they're, let's see. Nope, they just had earnings. Oh, wait a minute, that's Amazon. Hang on. Hang on. All right, so on the 15th, okay? On the 15th, and let me go back to here. Yeah, see, I'm not seeing anything out of the ordinary for next week, option-wise. I mean, the 42, almost 43 is a little bit high compared to most of these are down in the 30s. Okay, so that makes sense, okay? Most of these are in the 30s, high 29s, and then you've got this one, 42, right? Somebody else is saying, Blake is saying Zim. Yeah, there you go. Look how high, right? So if you look here, 95, so it's close to 100 implied volatility, and down here we're in the 60s. So this one looks like it has some pretty high volatility to begin with. So anyway, you get the idea. You can look over here as a quick down and dirty, right? But let me go back to Amazon. I'm going to show you another way that you can determine the volatility, whether it's high or low. I can do it on HD on Home Depot. So in here, if you go into right click on the chart anywhere and go into studies and you click edit studies, okay? So when you edit studies, if you go down here under I, you'll see implied volatility right there. So we're going to add that into our chart. And then if you go up here a little higher right here, you'll see it says historical volatility. You can add that. So now we have implied and historical. Now, if I click apply, right down here at the bottom, here's the implied volatility, here's the historical, okay? So you can look here and say, okay, the historical implied volatility is around right now, appearing to be about 20 cents. And right now we're about 31, okay? So that's not terrible. Now, if we go to Zim, let's go back there since it had pretty high, right? So you can see the historical implied volatility is 54, and right now we're sitting at 73. So easy way to look at that and go, pretty high, right? High implied volatility. Go back to HD, and it's a little bit higher. The average is 20, we're at 30, right? Now, another way, if we go back to, let's go back to Zim, just because that does have some pretty good volatility right now. The other thing that you can do is on the implied volatility is if you go up here on the trend line, right? Or actually price level, you can just drop in a price here at the high points, right? Drop in a price down at the low point. That's all the way down there, right? And then you can kind of just see that if you eyeballed where we are, where the midpoint should be, right? Of that, you can see that we're slightly above it. That's another way to do it. But you can just read the implied volatility, the historical and the implied here, and That's how you can determine whether you are in a period of high implied volatility or low. All right. Does that help people in terms of determining? Give me a 1 if you find that helpful to be able to determine the level of implied volatility. Good. Cool. Okay. All right. So let me get rid of these studies. So Matt, the VIX is the VIX is something, it's related, but in terms of, it doesn't really apply to what we're doing here. So I don't want to get sidetracked with getting into, the VIX, but you can look at, so it is options related. Yeah, so no debit spreads. This is just doing debit spreads on underlying tickers, right? So let me adjust my studies here real quick, get rid of these. Okay, let me go back to my screen share. All right, so here's, again, we covered when to use the debit spreads, okay? VIX is actually, that is a, it's, if you're talking about VIX, well, what I'm thinking of VIX. Yeah, it's the volatility index, right? So it's not, I'm talking about underlying like Microsoft, Tesla, that kind of, the VIX is a volatility index. Okay. So we're just going to stick with just standard tickers for this presentation. So let's go back to Amazon. Okay. All right. So vertical spreads also, there's several types of vertical spreads, but we're talking specifically about debit spreads. So there's diagonals, there's counters, but we're just going to be talking about debit spreads today. So again, perfect strategy for small accounts. You can use the market's money to help pay for your trade, which is kind of cool, right? You don't have to put up all the money. You reduce the risk and increase your probability of success. Low risk option strategy for creating income. And it allows you to profit from the movement of the underlying stock price without a large amount of upfront capital and the downside of buying the shares. So again, using the example of like Tesla or another high priced company, like sometimes it's just not feasible for somebody with a small account to trade those, but with a debit spread, it makes it easier to be able to trade those. Just go back to my notes real quick, just make sure I didn't skip over anything. Give me 1 second, just make sure I covered everything so far. Okay. Okay, so the max loss and gain when we're talking about using debit spreads. So, and again, I'm going to go through this, but then I'm going to give you examples. I'm going to walk you through. So in case this doesn't make sense, but the maximum loss is limited to the cost of the spread, meaning the debit. So I'm going to show you examples of what I mean by that. So, but the maximum loss is limited to the cost of that spread. So whatever you pay for that spread is your max loss. So worst case scenario is the underlying stock price is below the lower strike price at expiration. And again, don't worry if you don't understand what I mean by that. I'm going to give you examples. So if the underlying price is below the lower strike price at expiration, the long call or the long put, again, that's the one that you buy. In this case, both the long and the short legs of the spread expire worthless, and the total loss is the net debit cost of the position. All right, Tony, take care. Yep, you'll get the recording. So again, the max loss is just whatever the cost of the debit spread is. Okay. Then the maximum gain is capped. So it's not unlimited. So unlike with shares, of course, you can have unlimited gains, and you can have unlimited losses. Well, not quite. It could go to zero, and then you're done. But with using the debit spread, your maximum gain is capped at the difference between the two strike prices, less the cost or the net debit that you pay to initiate the position. And again, I'm going to walk you through. Sorry about that. Market's closed. I'll walk you through examples and we'll understand what that means. So, and then break even is the long call strike. Okay. So in this case, we would be going like in a bullish position. You're buying a long call, and then you're selling a call as well. But the break even is the long call strike price plus the net debit paid. So again, I'm going to walk you through what that means. So let's go to this. Let's go back to, I'll walk you through a couple examples right now. So if I go to the trade, if I go here, okay, I'm using Amazon. I'm using the October. Okay. And I'm just going to randomly pick something. This isn't what I would actually, what I would buy right now. I'm just giving some quick examples, right? And then we'll get into more specifics. So let's say if I was going to, if you right click on this and you say buy vertical right here. Okay. So right away that populates, and my default is set to 3 options. You can do as many as you want, but what this shows me right now is that I'm buying the October 21st $150 call. Okay. Now, then I'm going to sell the same. So we're talking about the same month, the same expiry. Okay. But I'm going to sell the strike that is farther away. Okay. So I'm not saying, I'm being specific by saying farther away. So the closer strike and the farther away strike, because if you're looking at doing this on the put side, again, it can get confusing if you're talking about, the greater price or the less price. So just think of it as the strike price that's closest and the strike price that's farther away. So the one that's farther away, I typically like to do a $5 spread. Okay. So I'm going to change that to 155. So I have a 150 strike and a 155. So I'm going to buy the 150. I'm going to sell the 155. And that is going to give me a cost of $1.78. Okay. Or $178 per contract. So let's just call it $2. Okay. So if the cost to do this debit spread is $2, then my maximum loss. So Matt, right now, if I wanted to do this, right, here it is. Here it is. This is what right now, all I would have to do is click confirm and send, and that order is placed. So that's it. So you're, step before. Okay. Again, this is recorded, so you can go back and watch it. So all I did was I went to the 150 strike here. Okay. So here, this is all of the strike prices and expiration. So this is all under the 21 October expiration date. Here's all the strike prices. I just went to the 150. I hovered over the buy here. I right clicked. I went buy vertical, and it automatically populated this. And again, I have my default set to 3 contracts, but again, you can do as many contracts as you want. So let me go back to here, and I'm going to do the 155. So again, normally when I'm looking at doing these, I'm using it, and we'll get further into it later, but I use a $5 spread. Okay. So I would be buying the 150 and selling the 155. Now, what that does for you is that if you look up here, okay, if I was going to just buy the 150 call, you can see that that's $5.85 per contract. But I'm only going to pay, I'm going to round this to $2. I'm only paying $2 because I'm selling the 155. Okay. So if I go down to the 155 here, right here, 155, I'm going to be collecting, because I'm selling that, I'm going to be collecting $3.75 to sell that. So again, I'm buying one and I'm selling one, right? Different strike prices, same expiration. So what that does is that gives me a net debit. So there's a cost that I'm paying here. I'm receiving a credit. The net debit here, that's again rounded up $2. Okay. So my maximum loss is $200 per contract. Okay. And again, if I have 3 contracts, that my maximum loss is $600. Give me one if everyone understands that so far. Cool. Great. Okay. And again, at any point, if somebody Wesley, if anyone, Wesley, what can I clarify for you on that so far? Again, don't be shy, because it's, that's why I'm here. If there's anything that okay, you're following. Cool. Okay. So the cost of this, my risk is going to be, again, I'm rounding it up, $2 or $200 per contract, $600. But again, I'm never going to let my loss be that total amount. And I'm going to explain that when we get into the risk management part of this. Okay. So maximum loss is the amount that you get credited here. Or I'm sorry, that you are debited, right? So it's costing you something. The maximum gained, okay, is the maximum gain is capped at the difference between the 2 strike prices, right? So you have 150 here and 55 here, okay? So that's a $5 difference between those two, right? So the maximum gain is the difference between these 2 prices, $5, less the net debit cost paid to initiate the position. So again, if I round this up to $2, my maximum profit is $3. Okay. So the difference between these two is 5 less what I paid 2. That means that my total profit on this is $300 or $3 or $300 per contract. Okay. So 3 contracts, that could be $900 maximum gain. Okay. Is everybody following that? Does that make sense? Perfect. Cool. My break even. Okay. So when you're looking at break even, it is the lower strike price, which is 150 plus your cost. And again, I'm just rounding this up to $2. So my break even, okay, when Amazon starts moving, my break even for this trade is 152. Okay. So when we go back and we look at the chart, Amazon has to hit $152, the underlying, in order for me to break even on this debit spread. Okay. Give me a 1 if that makes sense. Yes. By October. Yeah. So Blake, yes, by October 21st, because this is what we're talking about for expiration. Okay. So by expiration, and again, I'm going to get more into detail on that, but by expiration, you want the Amazon price to be at a certain level. So Brian, I'm going to, once we're done with this, I'm going to process the recording and I will post it in Slack. So you'll see it in there. And if for any reason you've got my cell, you can always text me and I'll shoot it to you. Right. Okay. So let's go back to the presentation. So if you hit 155 by the 15th, you can, so Blake, we're going to get into that. You can take your profit at any time. That's the cool thing about this, is there's different ways for you to go about thinking about taking profit. Okay, so we'll get there. So I just want to make sure you understand kind of the nuts and bolts of, you know, the max loss and the gain and how to structure this. So let's go back to the presentation. Okay. Okay. So the debit spread components. Okay. We already talked about it. We already went over some of it. But one thing I just want to mention real quick. Okay. So if you're trading, let's say if you're buying and you're trading calls directionally or puts for that matter, whichever. But if you're buying, you typically have to give yourself plenty of time. So there is a thing called theta. Okay. When you're talking about options. Okay. There's and I'll point it out to you when we go back to the option chain, but there's a thing called theta, which is time decay. And so time decay actually eats away over time at the value of your option. So if you're trading calls or puts directionally, meaning you're just buying a call or you're buying a put, time decay works against you. Okay. So you often have to give yourself, and time decay theta accelerates in the final 30 days that the contract before expiry. Okay. So in the final 30 days of the life of that option, theta accelerates, and you can even start losing money even though you're in the money. Okay. So you just have to be aware that theta is time decay. And when you're trading directionally, just buying or buying puts or calls, you have to give yourself plenty of time, so that you have to give time for the underlying price to make its move without theta eating away at you. So Albert, so let's just say in general, if I were going to get into a directional trade on directional trade with buying calls or puts, I might give myself, knowing that I want to be out. I want to be out once we hit that 30-day mark. So maybe I'll give myself 60 or 90 days, depending on the kind of move that I expect. Okay. With doing debit spreads, you don't have to be that concerned with theta, because theta works to the benefit of a seller of options. Okay. So it works against the buyer, but it works to the benefit of the seller. But with a debit spread, you're buying one and you're selling another. So you're straddling that line. You are both the buyer and the seller. So you don't have to be as concerned with theta, because the theta is going to eat away at the value of the option that you've sold. And it's it's going to, yeah. So it's the theta is going to work in the favor of the option that you sold, and it's going to work against the option that you've bought. Okay. But they kind of offset each other. So you don't really have to be that concerned about theta. So with this, I mean, you can go 30 days out, you can go, but again, when we're talking about how far out to go, I'm going to focus more on the chart than I am the amount of time left. Okay. So you're going to use the chart to see where you want the move to happen. And then you're going to try to determine how much time that's going to require. And that's how you're going to choose things. So let's just go back to the debit spread component. So, so I already mentioned the option expiration. So the long and the short strike have the same exact expiry. So when we were looking at the option chain for Amazon, we were talking about the 21st of October, which is 70 days from today. Okay. So strike selection. Okay. And this is Albert, this is kind of what I was just talking about. So strike selection, you're going to choose a strike based on where you think the underlying can go. And we're going to look at a chart in a little bit. You don't need to go as far out when buying a long call or put. So you don't have to go as far out as when you do buy a long call or put, because theta is not much of a concern. You just need enough time for the underlying to make its move. Okay. The long strike and short strike. So you buy, and again, I'm using the term closer strike and strike farther away, as opposed to lower and higher, right? Because if you're doing this to the downside, you're talking low and lower. So it's just easier to refer to it as a strike closer and a strike farther away. Okay. So you're always going to buy the strike that's closer in time, and you're going to sell the strike that's farther away. And again, typically I like to do it with a $5 spread. Okay. You can increase that, but by increasing it, and I'll give you examples, increasing that also increases your risk. Okay. So when we talk about a stop loss, okay, there's a couple different ways to do this. Hang on a second. I'm going to mute 1 second. Just get a drink of water. Hang on. Okay. So stop loss, couple different choices for your stop loss. You can do an absolute zero, right? So is everyone here familiar with the term absolute zero? Give me a 2 if you are not, and I'll explain it. Good. Okay. So absolute zero just means that your risk, you're willing to let it go to zero. So in the example before, like let's say if I have a, in the example that we're looking at before with Amazon, and that net debit was, again, I'm going to round up $2. Okay. Let's say, so that's $200. So let's say if I have a $200 R, I can do one contract and I could do what we refer to as absolute zero, meaning I'm not going to have a stop. Okay. My risk is my R. So if I have a $200 R, I could do that, that debit spread that I showed you earlier, and I could do it with one contract. And if I lose that full $200, that's my absolute zero, right? So meaning you're willing to risk the full amount of what you're putting up because that's your R. So that's what we've referred to as absolute zero. Okay, good, great. So basically absolute zero means you're just willing to risk it all. You're going to let it go. And if you lose the full 200, you lose it. Okay. So the other thing, the other possibility is doing if you don't want to do absolute zero, if you do want to have a stop, you can you could just say, okay, well, if the value, if I'm wrong and Amazon doesn't go in the direction I think it's going to go, if that debit spread loses 50% of its value, then I'm going to exit it. Okay. So for instance, if I paid $5 for that debit spread and it doesn't move in the direction I think, when the value of that hits $2.50, meaning it's lost 50% of its value, I can exit it there. Okay. So in the previous example, that if it was a $2 cost to do that debit spread and you have a $200 R, well, then if you're using that type of stop loss, you can do 2 contracts, right? Because 2 contracts is going to cost you 400, but you know that if it hits 50%, you're going to exit. And so your loss will have been 200, which is your R. Does that make sense? Give me a 1 if that's clear. Okay. Is anybody unclear on that? Because I could try to explain it again. Okay. Looks like I'm getting a bunch of 1s. That's fine. Okay. Then the other way to do this is a stop loss based on the chart, same as if you were to buy shares. Now, what I personally do is I use all 3. Okay. So I will do this with an absolute zero strategy, but when I'm talking about using a stop loss, if I'm not using absolute zero, I will use a combination of these 2. Okay. So I will say that my stop loss is going to be 50% of the value, the original value of that debit spread, or the stop loss location on the chart, whichever comes first. So let's say if I look at the chart and I go, well, if I was going to be trading this in shares, here's my stop loss. And let's say it gets down to my stop and I've only lost 25% of the value of that, I'm still going to exit it. So that's how I personally do it. I combine, if I will do absolute zero, but if I'm not doing absolute zero, I do a combination of these 2, whichever comes first. Okay. So if it loses 50% of the value before it would have hit my stop loss based on the chart, I'm out. If it hits a stop loss based on my chart and I still have more than 50%, let's say I've only lost 25% of it, I'm out. Okay. So give me a 1 if all that makes sense, combining those two. Great. Cool. Okay. Now, here's the choices. Okay. You can do deep in the money, DITM. These are just some acronyms: DITM, ATM, or OTM. So deep in the money, at the money, out of the money. Okay. And I'm going to give you examples of this. So don't worry about getting caught up in, well, what does that mean if you're not familiar with it? Okay. So deep in the money, all you need to know is that it's going to be a higher cost, which translates into a greater risk, right? So higher cost equals greater risk, but there's a greater probability of profit, meaning that it's more likely to be profitable than if you go at the money or out of the money. Okay. But you're typically risking 4 to make 1. Okay. And I'll give you examples. So it's not that much different than doing a credit spread. Okay. So those of you who might follow Tony and his credit spreads, it's kind of the similar risk profile as doing a credit spread, except that it's a debit spread. So you're typically risking 4 to make 1. Now, then the other option is at the money. And with at the money debit spread, you're typically looking at a 1-to-1 risk versus reward. Okay. Your long strike, meaning the one that you buy, would typically be 1 or 2 strikes in the money. And then the one that you sell would be out of the money. And again, I'm going to give you examples of this. Okay. So that's typically 1-to-1. Then you can do out of the money. So this is the lowest cost option. And this is where you typically will risk 1 to make 4. Okay. And with that, I'm typically looking at a delta. And again, don't worry about the term I'm going to show you. I'm typically looking at a delta of 20 or 25 when I'm doing out of the money. I don't go lower than a 20 or 25 delta. So let's pause there on the presentation part of it and go back to the option chain just so we can talk a little bit about that. Okay. Oh, did not mean to stop the share. I'll just go back to. Okay. Can everybody see the, I got to pull my chat back up. Sorry. All right. Can everybody see the option chain again? Give me 1 if you were seeing the option chain. Perfect. Cool. Okay. All right. Let's take a look at those different scenarios. So far, real quick, any questions, anything you want me to clarify? Okay. Not getting any responses, so we'll keep going. Okay. So deep in the money. Okay. So if you're looking at the option chain, again, I'm just going to focus on doing a bullish debit spread. Okay. If you're looking here, so right here, you can see the different, this area down here is, this area here is shaded. This area is not shaded. Everyone can see that. And that's the difference between the 145 strike and the 140, right? So the 140 is in the money. The 145 is at what they call at the money. If you go up here, now we're talking deep in the money. Okay. So let's say if we wanted to, so let's start with the deep in the money. Okay. Just for fun. Let's look at if we did the 90, right? So right now, Amazon, let's see, let's go back to Amazon. So Amazon closed today. Close was, it's called 143.50. Okay. 143.50 was the close on Amazon today. So if we go back to the option chain, okay, let's say we want to look at the 90 strike, okay, or maybe we don't even have to go that deep. Let's say if we wanted to go 100, okay. So right now Amazon is trading at 143, right? 143 and a half. So if we look at the 100, okay, and you go, okay, well, I'm going to go deep in the money, right? If I go 100 and I do a buy vertical here, okay, and I'm going to do the 100 right? So I would be buying the 100 and I'm going to be selling the 105. Okay. That would cost me, my cost to do that would be, just call it $5. Okay. Or $500 per contract. Okay. So if I did 3 contracts, that's $1,500 that it would cost me to do this. Right. But can we all agree that at 100, right? I'm talking 100, 105, Amazon really has to tank in the next 70 days for that not to hit, right? So when you're going in the money, and if you think about the difference here is $5. So yeah, so you're actually paying more than see, that's why this wouldn't work, because you're actually paying more than what you can, you're beyond $5, right? So you would actually have to go out even farther. Let's say it's a $10. You would have to extend the spread here. Let's see here. Okay. Okay. So here, think about this. When you're deep in the money, you're paying $9.43 to make 10. That doesn't work, right? So sometimes even going deep in the money just doesn't make sense. It doesn't work. You have to try to, like I said, for this, you typically want to make risk 4. So you want to, ideally you would want to see a difference. If this is 5, you want this to be a let's say if that's a 4, you want to at least have $1 here, right? Yeah, level 2 rock will get you there. Okay. So yeah, if you have level 2 options, you can do this. So again, you're looking for a profitability. You want to risk 4 to make 1. Okay. In this case, you're risking $9.43 to make 10. That doesn't work, right? So you wouldn't do that. Let's go here. Let's go a little bit closer to in the money and just do the 120. 120, 125. Okay. Now we're getting a little closer. Okay. You're risking $4.33 to make 5, right? So still, we're not exactly where we would need to be in terms of risk reward. So let's try this one. Okay. That works. Okay. So you would buy the 125 and you would sell the 130. Now your risk is, it's called $4. Your maximum gain is the difference between these, which is 5 minus 4. There's your $1, right? But you're talking about doing this, it's already in the money. So Amazon would have to really tank in order for that not to be profitable. I personally don't like to do that kind of a trade. I would rather be either at the money or out of the money. And I'm going to show you why in a second. If we go at the money, okay. So let's say if I go 1 or 2 strikes in the money, let's say if I go here at 10.95, right, the 140 strike, and I want to go buy vertical, and I have a 140 and I'm selling the 145. Again, I'm looking for ideally a 1-to-1 here, and I'm not getting it. That's almost $3. So I'm risking $3 to make $2, right? So that doesn't really work for me. So ideally at the money, you wouldn't be seeing a 1-to-1 risk versus reward. So you just have to play around with this a little bit. But now let's say if we go out of the money, okay, let's go back to the chart now. Let's look at a real example. Okay. If I go back here and I'm looking at Amazon, and right now, okay, right now, Amazon is just, see this thick black line and this thick red line. This is the monthly 20. This is the monthly 10. Okay. So Amazon right now, the price is sandwiched between these. Okay. So It's going to have to break one way or the other. We have a inside candle right now compared to yesterday's candle. So some people will just trade based on the inside day candle. If it breaks above that, then they expect the price to go bullish. But if we look here and we go, okay, well, let's go back to the daily. Okay, go back to the daily. And if I'm looking at where I think Amazon can go, the next target that I would be looking at, let's just say if we're looking here, this point, and I drop in this line, I go, okay, well, that's probably a pretty good target for Amazon if I'm thinking that it's going to go bullish, right? So I'm assuming, okay, I think, the market may have hit a bottom. It's pushing up, Amazon is starting to recover. If I do a trend line here, I can drop in a trend line and go, okay, well, Amazon could easily, get up to that trend line, bump into a little bit here, get into, and then if it gets into this trend line, then it's going to have, this is the one of the higher time frame moving averages here. That's the 100. It could get back down into that and then come up and break through that trend line. Okay, just again, I'm talking hypothetical. So let's just say that we think that between now and 70 days from now, which we're talking October 16th, I think was the date that we're looking at, or 21st, I think Amazon could get up to 158, right? That's what the level that we're looking at is 158. So it's like, okay, if I'm bullish on Amazon, I think it can get there. Let's just set up a trade based on what we think Amazon could do. Okay. So if I go back to the trade tab, again, if I look at all of my option chain here, right? Okay. Do I really think that Amazon can get up to what did we say? 158, right? Do I really think it could do it in the next 35 days? I don't know. Like, maybe, but if I look at, if we go back to the chart, it's like, things are kind of chopping around here. 35 days, I'd rather have a little bit more time. Does everyone agree that you'd rather have a little bit more time on your hands than 35 days? Yeah. Right. So why not? Right. So let's give it more time. 35 days. Again, when you're talking debit spread, you don't have to be that concerned about theta. So time decay isn't so much of the issue. It's really just, do I think Amazon can get to that level in 35 days? And I think that's asking a lot out of it. Okay. So let's just go back to the trade tab here. And I go, okay, well, I could do weeklies. Yeah. But I'm going to look at the monthly. I'm just going to go back to this October 21st thing. And I said, okay, I think it could get up to 158, right? We wanted to get to 158. So let's just call it, we could call it 159. We could call it 160, right? Now, the other thing I want to point out to you that's I always look at is, so here's the theta column that we've been talking about. Okay. Here's theta and here's delta. Okay. So I already mentioned that when I'm talking about the going out of the money, because that's what I'm talking about doing right now. Out of the money, I'm looking at a delta of 20 or 25, somewhere no lower than a 20. Okay. So if I look here and I say, okay, well, 160 is pretty close to, I could go 158. But here's the other thing that catches my eye when I'm looking at all of this information over here is open interest. Okay. So when I look at open interest and I see, okay, all of these are under 1,000, right? You get under 1,000. This popped a little bit over 1,000. You come down here and most of these, but look right here, 18,000, over 18,000. And that's the 160. Okay. That tells me that there are people out there that know more than I know, right? That are probably looking at that and going, yeah, I think Amazon could probably get up there, right? Look at the amount of open interest there compared to everything else. right? Again, it's just a gauge for where you think a stock could possibly get to, because there's that much interest at that price level, so much more so than everything else, right? You can see that, this that's not just orders and toss, that is contracts, total contracts. Okay. So yeah, so it is actual orders, right? So if you so it's actual contracts that are in place. Okay. Actual call contracts. So when you look here and I see that 18,000, I'm like, okay, I think there's a lot of interest there. That makes sense. So if I go 160 and I say I'm going to do the 160, and if I look here, the delta meets my criteria. I said 20 to 25. So far, everything is looking good. I can go here and I can click buy, and then I'll go buy vertical. Okay. And it's a 160. And then I want to do a $5 spread. $165. Okay. My cost to do that is $100. Okay. $97. So depending on the type of stop that you want to use. Okay. If I'm going with a 50% stop, and I could say, okay, well, if I'm going to use a $500, if my cost to do this trade is my R for this is 500. That means I can do, and if it's going to cost me $100, I can do 10 contracts, right? So, because again, I'm going to, if it's 100, if I did 5 contracts, that's 500, right? If I did 10 contracts, my initial cost is 1,000, right? Matt, you're right, 1,000, but that's not my R. I'm saying that my stop loss is going to be 50%. Okay. So that means I can, if in this example, if my R is 500, I can do 10 contracts, because that is a upfront cost of $1,000. But if this doesn't work and I have to exit, I'm going to exit when the value of this debit spread hits 50%, right? Or $500. So my actual risk that I'm going to put on the table, even though it's going to cost me 1,000 up front, my actual risk that I'm putting on the table is 500. Okay. Does that make sense? Give me a 1 if that makes sense. Great. So in this case, I'll do 10 contracts, right? 10 contracts, but you can see, yes, it's out of the money, but you're giving Amazon 70 days to get up to 160. And there's clearly a lot of interest in that. Yeah. So my risk reward is better, right? So my cost for the trade, right? So when I said before, when you do out of the money, typically you're risking 1 to make 4. And that's exactly what we're talking about here, right? Because the difference between 160 and 165 is $5, but it's costing me $1 to do that. So I'm paying $1. That's $1 risk to make $4. Does that make sense? So there's how I'm coming up with I'm risking 1 to make 4. Does that make sense to everyone? Give me 1 if that's understood. Yep. Cool. Good deal. Okay. So that's where you can, especially with a smaller account, right? Where you can do this and do it in a way that it puts the probabilities in your favor, right? To hit this. So let's talk about a couple of things. Let's go back to the chart. I think I'm skipping over something. Let me just make sure. Okay, let's go back and let's look at Amazon and let's look at the chart. Okay, so we could set up this trade, right? And we could say, okay, well, if I was going to trade shares, right? and let's say I was going to trade shares, and this is just all hypothetical, right? But if I said, okay, well, I'm going to go long on it on Amazon once the high of this is broken. Okay. So we have an inside day. We got, really good volume on this indecision candle here, but we've moved up, right? And now we've consolidated here. We've gone sideways a little bit. Now we got to have an inside day. If it pops, I'm getting into this trade. Well, where would my stop normally be? Well, here's the last pivot low. So my stop can be down here. So what I can do is I can just put in and say, okay, well, let's say if my, I can put in the low of this candle, 136.21, right? So if I want to go, let's just say I can just do an even 136, right? Just for argument's sake. Okay. So there's 136. Okay. I'll adjust that. Okay. 136. So that's going to be my stop level. So I'm going to have two different stops. I'm going to be watching the value of that contract. And if it hits 50%, I can exit. Or if it gets down to 136, I'll exit. Okay. Whichever happens first. So that's how I'm going to manage the trade. That's going to be my stop loss. So if I go get in this trade, I can actually, I'm going to go into back here. If you look here, right? So let's say I'm going to actually do this trade. I'm going to move this up. I'm going to say I want 10 contracts because again, in this example, I'm saying I'm going to do, a 500, my R is 500. That's what I'm doing. That means if I'm sticking with my 50% stop loss, I can do 10 contracts because I will exit at 50%. That means my actual loss is 500, which is my R. I can go into here. Okay. This little area right here with there's a little cog. Or maybe I can't. Maybe I have to, right here, hit underneath there. Okay. So I'm not going to get into all this right now, but you can actually set up your stop loss. And it's like an if then type of statement. So you can actually get in here, and there's videos on how to do this. But you can actually put in here, and you can put in the stop loss based on the underlying price, right? So we said, what did we say? Whatever price that was that we said, 130, I think it was either, but you can put in the price or you can put in the value of that. So you can actually set this up and you can set it and forget it. And it will go ahead and it will take you out of the order if that level is whichever comes first. If that 136 is hit, or if 50% of the value is hit, that's your stop loss. You can set it and forget it. You don't have to worry about it. You don't even have to track it, right? So that's a great thing about Thinkorswim and how you can set up option trades in that is you just do it and you don't even think about it, right? You set your order, you get into it, you just let it ride. So that's how I would go about setting up my stop loss, is based on the chart and then also that 50% range. Okay. Now, couple things. Okay. Let me get into a couple different things that you do need to know about. Okay. Okay. So the plan is you do not have to hold these to expiration. Okay. So there's different ways to, and I thought I had, maybe I just have my notes here. Okay. So you don't have to hold these to expiration. Okay. And let me put my, let me go to here and I say, we were talking about doing, I'm going to get rid of this line here. Okay. And let me just put in a price level here. So I was saying 160, 165, up 160. Sorry, that's for the line. Okay, there's my the strike price that's closest, right? So that's the one that I am buying. Now, if I duplicate this and move this up to 165, okay, extend this. Okay, so let me color code these. Just okay. So in this example, we're doing we are buying the 160, we're selling the 165, right? And this is again 21st October 2022. Stop loss is right down here, right? So we have our entry here, targets, right? And then our stop. Now, where are you profitable? Okay, that's the question. So your max profit, the max profit is realized when price exceeds your short strike. That's the farthest one away. So that's 165. So your max profit is going to be exceeded when price is above here. Okay. And anywhere below that, it's not max profit. Okay. And again, you also have to remember that our break even on this, right? It's costing us $2 to do it. Our low strike is 160, right? No, I'm sorry. It's costing us $1, right? It was $1. Yeah, it's costing us $1. So our break even is the 160 plus our cost to enter this trade. So break even is 161. So if price hits 161, we break even. If it goes beyond this short strike, we are at full profit. Okay. And then we can be anywhere in between, right? So you can decide what you want in terms of your rules and how you want to take profit. Okay. So again, the max profit is realized when the price exceeds your short strike. That is the farthest one away. That's the one that you're selling. Okay. And it can only be achieved if you hold to expiration and price is above that level. Okay. You have to hold all the way to expiration and price needs to be above this level. Now, word of caution. Okay. You always want to close this position if it is in the money. Meaning in the money, mean if you're at max profit, okay, if price is above your short strike, you want to make sure you close this position. You do not want to let this expire worthless. Okay. And the reason being is what you're buying here is your protection for what you sold. Okay. And what will happen is if you don't close this position, it is possible that the broker will assign you the shares, because technically if you took away this one that you bought, you're naked, right? So selling means you actually have to buy them at that level, right? And if you're buying, that means you can buy them at this level. If you don't close the position, and this has happened where a broker, this one that you bought, if you do not do anything with it, it will just go away. But this one, the one that you sold, they will assign you the shares. Okay. So you do not want to let this expire without having closed it out if it's in the money. If price is above here. What you can do if you ever wanted to, and I don't know why anybody would, just close it out and take your profit. But you would have to inform your broker that you want to exercise your right to buy shares here. Okay. Which would mean that you would then have to put up all the money to buy however many shares at 160 in order to cover the this naked position up here. So all I'm saying is, do not let this expire worthless. Close this out. Do not let this hit expiration and then on a Friday and then all of a sudden over the weekend, you get assigned these shares, but you never told the broker that you want to exercise. So just word of caution, always close this position. Don't let it expire without having actually closed it out. Okay. So Matt says when you are selling. So again, there's two legs to this, right? One is you're buying long calls, and one is you're selling the call. So just the net of that is just make sure that you close this position. Don't let this expire without you actually doing something. Okay. Now you can hold for maximum gain. Let's say your break even on this is 161, right? So if we dropped in a line at 161, that is your break even. Okay. Anywhere above 161 and way up in here, you're at, you're either going to be at max profit up here, or you're going to be somewhere in profit in this range here, right? Between 161 and above. So you can set your own rules for how you want to take profit. You can hold for max profit, and then you can close the position once it's at max profit. You can say, well, if my risk is, my risk on this trade was $1, when my profit is $2, I'll exit, right? So 2 times your risk, you could exit then. You know that your maximum profit on this particular trade was $4, right? You were risking $1 to make 4. So you can close it out. You can say, okay, well, at $2, I'm going to close this position because I just made 2 times my risk. Okay. You could say at 3 times my risk, or you can hold for the full 4. It's up to you, but you have to come up with your own rules. Okay. So, and the other thing I will mention again, this long call, this one that you bought, is your protection against here. And when I say protection, meaning your protection is that you can exercise shares in order to cover shares if you get assigned up here. And again, but just don't let it expire worthless. That's not worthless, but don't let it expire. That's the key thing you have to know. So the in terms of exiting, in terms of your profit taking, that's entirely up to you. Okay. Again, you could hold for the full max amount. You can Albert, I'll get to that question in a second. You can hold the max amount. You can take it off at 2 times profit, 3 times profit. That's up to you. Okay. But just be aware that you need to know what your break even is. And on this example that we've been doing, it is 161, right? So anywhere above $161, you are going to be in profit. Okay. So to answer your question, Albert, do I ever unravel or not at all? Look, here's the thing. There are things that you can do to play defense here, but the most straight up answer is just stick to the rules of 50% loss, you're out. If it hits your stop loss level, you're out. So, I'm not going to get into, and I only have 8 more minutes, so there's not time to get into, the defensive actions that you could take, but irregardless, the defensive actions that you can take are going to cost you money. So in the end, you're probably better just closing the position, taking the 50% loss, or getting out at, if price gets down here into your stop loss, right? So yeah, there are things you can do, but I would just say, just keep it simple and just exit the position instead of trying to fix it or unravel. You're still dealing with Netflix. Yeah. So just the simplest thing is just take the loss, right? And if you know that you're willing to lose 50% of, of the total cost, then that's okay. Again, 50% loss, or if it hits a stop, whichever comes first. Okay, questions. We have 7 more minutes, and that is pretty much everything I have. There's not a whole lot more. Just going through my notes. I don't know if there's anything else I can. So again, plan to close these before expiration. Do not want the options to expire without closing out the position. Yep, we talked about that. Your risk is being assigned shares, the short ones. without having the ability to exercise the long option. So, yep. So anyway, any questions? We have 6 more minutes. We can we can look at another example if you want. We have enough time. I can go into, we could look at maybe I think AMD was another one that I looked at. Would everyone like me to do another example? Okay. Let me get rid of these lines. Okay, let's take a look at AMD. Yeah, Matt, don't unwrap. Just stick to your stop loss rules, right? Okay, so AMD. Okay, we look at AMD. This is interesting. I didn't notice this until just now, right? AMD on the daily. What do we? Anybody recognize what we have going on here potentially? Anyone recognize that pattern? A happy face. Not quite. Anyone else? Cup and handle. Boris got it. Joe. Yep. 100%. Yep. So what we're potentially looking at here is a cup and handle, right? So here's the cup. Here's the pullback, right? Few days of pullback. And now we're starting to push higher. So if this level is broken, that would be a bullish move, right? So let's say you look at that and you go, oh, pretty cool. Cup and handle forming. And on top of that, right? On top of that, AMD is also kind of sandwiched right in here now between, here's the 20 on the EMA on the monthly. I'm sorry, the 10 EMA on the monthly. Here's the 20. It's sandwiched in between those, but it's a cup and handle. It's building. We got this nice hammer. I'm looking for it to push out of here. Okay. So you go to the chart and you go, okay, well, where can it go? Okay. If I look at AMD, I'm going to go, hang on a second. I think Jeremy might be logging in. If I look at AMD, I'm going to say, okay, I think AMD can, over time can get up to this 123 level. Okay. Just call it 123. So if I go into my AMD, go into this, and I'm going to stick with the same expiration, the October. Okay. So if I go to AMD and we said the level we're looking at is 123, call it 125, maybe 120, somewhere in that area. If I go back to here, okay, I'm looking for, again, the delta I'm looking for is between, if I'm going to do these as out of the money, I'm looking for a 20 to 25. Well, that 120 has a delta of 21. Okay. If I go farther out, if I go to 125, my delta doesn't work. It's too much below. So I can go here. I can say, all right, let's go buy this vertical. And I'm going to go 120, 125, right? And again, here's my cost, right? So my cost to do that is 72 cents. So less than $1. So you have a pretty good risk to reward. It's better than you're risking 1 to make a little more than 4, right? Because if we could just call that 75 cents, if your cost is 75 cents, you're looking at making $4.25. So Albert, the take, if you're buying, what is your take on buying put if stock goes again? Yeah, you could do that as well. I mean, that's one of the, again, I didn't want to get into all the defensive actions just because we didn't have the time. But yes, you could actually go in here. What you want to do is when you, there's a way to find out overall here, what your delta is, the combine between these, and you would want to go find a comparable delta here on the put side. So yes, that is something you could do. But again, kind of more, it's easier again, just to stick to your stop loss. Okay. So anyway, in this example, we would look 120, 125. Our cost on this is, let's say, 75 cents. So that means break even on this is 120 and 75 cents. That's our break even. Go back to the chart here, and we could say, okay, my level is 120, right? 120, 125. Those are my levels. My stop is going to go down below this pivot here. So right down here. And again, I'm still going to use, if the value of that, so it's 75 cents, right, is my risk. So let's say if it gets down to 35 cents, 37, 37 cents, that's my 50% level where I'm going to exit, right? If it doesn't work. So I'm going to get out, and I'm going to use that 35 cents, 37 cents as my stop loss, or this level here, whichever comes first, right? So anyway, we're at 5 o'clock. I know I think Jeremy is here.
It's me.
Oh, Yates is, oh, that's right. You're doing the afternoon swing room. Got it.
Jeremy's doing he's doing hard things in Colorado Springs.
Got it. Okay, cool. Well, perfect timing. We just wrapping up the debit spreads now. I try to get in one more quick example before you had to get on. So anyway, hope everybody found this helpful. It is going to be recorded. I will process the recording. I'll get into Slack for everyone. Yep, it's a lot of information. Go back and rewatch it. But again, for smaller accounts, this is a really great strategy. And you can see, especially if you go a little bit out of the money, how, you can do this with little upfront cost to you and little risk. All right, Yates, I'm going to make you host.
All right, sweet. And so you were just recording to your computer, so I can just record to the cloud now. So we're good.
Exactly. I'm going to make you host.